Welcome everyone to today's webinar. We appreciate you joining us and appreciate you joining right on time. We have a few folks who are still trickling in, and we will start the presentation in about a minute or two. So thanks for your patience, and we'll see you momentarily. All right, it's 12:02. Let's get started. So welcome everyone. Thank you for joining today's Summitry Concentrated Positions Solutions discussion. I'm Alex Katz. I'm the Chief Growth Officer at Summitry, and I'm joined today by three of my colleagues, Braren Land, Alex Leitzis, who are both principals at Summitry, and Aaron Zager, who is a senior financial advisor and manages our team of advisors. And you'll hear more from them momentarily. And I'm sorry we made it complicated on you, but we've got two Alexes, an Aaron and a Braren. So that's your crew for today. Now, we like to think of having highly appreciated concentrated stock positions as one of the most enviable problems to have, and yet the tax consequences and liquidity constraints are a problem nonetheless. I'd imagine many of you who are joining us today have this happy problem in your lives and you're looking for a solution. And I'd also like to welcome our current Summitry clients who have joined us for today's conversation, as I know we have quite a few of our clients on the webinar. And also, I'd like to welcome our partners and friends from Intero Real Estate and their clients who have joined us for the conversation today. Now, for today, we're committed to ensuring that our talk is, first of all, educational, and yet we don't want to put you to sleep. So we'll have a mix of client stories mixed in with the explanations of some of the strategies we might deploy in this very common Bay Area financial concern of concentrated wealth. And just a quick housekeeping item before we really get going. As questions come up for you, please click on the Q&A button at the bottom of the screen and submit your questions. We'll address as many of these as we can get to at the end of our talk, and we'll end promptly at 1 o'clock so you can get back to your lives on this Wednesday. So before we jump into concentrated positions, a very quick introduction to Summitry for those of you who don't know us. We're a wealth management firm that delivers in-depth financial planning and institutional grade portfolio management to our clients. But more importantly, we're focused on helping Bay Area families navigate the opportunities, challenges, and complexities that come with life in this unique place we call home. And there really are some unique financial concerns that exist in the Bay Area. Certainly the cost of residential real estate and making effective decisions around real estate is a big one. And of course, given how many folks in the Bay Area work for publicly traded companies and receive stock-based compensation as part of their overall income, strategies for dealing with concentrated wealth is another big concern that we see on a daily basis. So with that, let's jump into today's talk. So for some context, when a new client comes to us looking for solutions for her concentrated stock position, we do not immediately start in on tactical solutions. And I really can't underscore this enough. This will become clear as we continue today's conversation, but how we might how we might address one's concentrated position is entirely dependent on the client's overall plan. So in short, we may have a dozen tools in the tool belt, and financial planning is how we understand which tool or tools are the right ones for the job at hand. Financial planning is what tells us what the portfolio needs to accomplish, when it needs to accomplish it. It uncovers tax optimization opportunities and ultimately help aligns one's wealth with one's personal ambitions. So again, all of the factors on the screen and many, many more are part of this comprehensive financial planning exercise, which must be completed before we get into the tactical solutions around concentrated wealth. So now let's shift gears and we'll start at the beginning with a quick primer on diversification. So on the left, you see a portfolio with a highly concentrated position making up roughly 75% of this individual's wealth. On the right, you see a diversified portfolio. And as the slide shows, concentration can be a great wealth creator. It's a swing for the fences kind of an approach, and every once in a while you hit a grand slam. Of course, when you're swinging for the fences, you have a higher likelihood of also striking out than when you're, just batting for singles and doubles. So to continue with that baseball analogy, the diversified approach on the right attempts to be more consistently hitting singles and doubles, because as they say, hitting consistent singles and doubles will still get you in the Baseball Hall of Fame. Now, if we drill down one level deeper, the next question might be, okay, how much diversification is the right amount? And there's quite a bit of academic research showing that when you own 20 to 25 stock positions in your portfolio, you've reached a point of diminishing returns with respect to diversification. However, there's a huge caveat to that 20 to 25 number. The correlation between the 25 stocks matters deeply. So for instance, if you owned 25 stocks and they were all tech stocks that acted similarly, meaning they were highly correlated to one another, you're not really accomplishing effective diversification. And for all intents and purposes, you might as well own 3 or 4 stocks from a diversification standpoint. So the composition of the stocks themselves matters quite a bit. Now, we use a risk analysis tool. Let's go to the next slide. We use a risk analysis tool to scrutinize all of our prospective clients' existing portfolios. One of the best features of this tool is an analysis that allows us to quantify the diversification benefit within a portfolio. And here's an example of that output. So in this tool, all portfolios are given a score of 1 to 99 for risk. And for context, a portfolio consisting of essentially the S&P 500 would receive a risk score of about 74. An all cash portfolio would be a 1, and let's say an all Tesla portfolio would be a 99. So looking at the left, the bands in the circle graphic represent the size of each position and its correlation with the other positions in the account, with dark green being highly correlated and dark blue being anti-correlated. As you can see in this example from a client who happens to work at Facebook, there are some very large positions in the portfolio, and there's a lot of dark green on the correlation chart. So the great part about this software is that we can quantify the diversification benefit in this portfolio. So in this case, a weighted average of all of the individual positions' risk scores you'll see on the right would result in an overall portfolio risk score of 93. Again, that's just a simple weighted average. Through diversification, this client has only decreased their overall risk down by 1 point to 92, which is to say, not a whole heck of a lot of diversification. Now, When we shift to the next slide and we looked at a Summitry managed portfolio, this is still an all equity portfolio. You can see that the position weights are much smaller overall, and equally important, there's much more light green and even some blue here, meaning much less correlation. So we're able to reduce the risk from a weighted average, in this case of 88, down to a risk score of 58 due to diversification. And again, important to note, this is still an all equity portfolio. So the composition and correlation of the actual stocks matters deeply to the overall risk profile, again, bringing it down to 58 relative to the S&P 500 at 74. Now, before we get into our first story, I do want to repeat one more time that once we've decided that there is a concentration risk in need of addressing in a client's portfolio, we must contextualize any strategy for diversification within the overall financial plan. And what we've listed on the next slide are some of the major considerations that we take into consideration when we're looking at diversification in a financial plan specifically. So you see your liquidity needs, capital gains, and tax impact, of course, is a huge one. For employees of the company who where you hold the concentrated position, which is quite frequent, we have stock trading restrictions from time to time. Of course, charitable aspirations and other gifting strategies and others can come into effect when we are determining the best strategy for diversification. Now, for today's conversation, we'll address 7 of the tools that we have in the tool belt. Let's go to the next slide. And note that in many of these cases, we'll deploy multiple solutions to solve a given client situation. So listen for that in both the stories and as we go into the more educational component of the talk today. So before we get into that educational section, before we talk tactics specifically, I'm going to ask my colleague Braren Land to share a recent case of some of the work we did with a client with some highly concentrated positions. Braren, I'll turn it over to you.
Excellent, thank you, Alex. I'll kick us off here for story time. So the client situation I wanted to talk about today, a Facebook executive, married, 2 children in high school.
Hey, Braren, sorry to interrupt. It sounds like we've got some bad feedback on your end. Maybe mute and then come back off mute for a moment.
Try that again. Is that any better? If not, I can take off the headphones.
Yeah, let's lose the headphones. That fixed it. We're back in business. All right, take it away.
Sounds great. Okay, as I was saying, we're going to kick off story time with a Facebook executive, married, 2 children in high school. Loves his work, gets a lot of energy out of the projects that he had at work. But as he grows older, he sees his parents growing older, his kids kind of growing up, getting ready to go into college, and he was at this inflection point of wanting to spend more time with his family. He put a lot of the financial stuff on the back burner, and had just been keeping his head down at work, and now was the time to kind of get started and kind of get things organized. So the problem that he brought to us was really a $20 million plus concentration of Facebook stock, and which pretty much made up the majority of his net worth. And there's different tax lots, and really what he was looking to try to accomplish is before he leaves and retires, is trying to figure out through these different tax lots how he's going to recreate a salary for himself. And definitely confident in Facebook's future as we were, but wanted to carve off enough to where regardless of what happened, he would be able to take care of his needs, his wants and wishes for his family, and turn his concentration into an income stream. There was also, as we dug in the financial planning process, we were able to find some problems that he hadn't quite thought of or hadn't addressed as well. For one, no estate plan. So there's the protection of assets from going to probate, of course, but there's also the idea that his kids are not too far off from being 18 years old. And if something were to happen to him and his wife, he definitely wouldn't want there to be just $20 million going directly to the kids at 18 years old. So definitely some things that he needs to accomplish or needed to accomplish from an estate planning standpoint that we put at the top of the priority list as well. So this is a client not worried about running out of money, but more worried about each is being as efficient as possible in just each and every one of the financial decisions that he needs to make. And at the time that we met him, he just didn't know the first step to make. So he's really kind of in a state of paralysis by analysis. So as Alex mentioned earlier, we started with a financial plan. We determined the amount that he would need to diversify out of in order to just take care of all of his lifestyle needs. And for him, it was about a third of his position, which amounted to an income stream of around 2 times his salary. And the next step was bringing in one of our partners, who's also one of the portfolio managers, to do a thorough analysis on the valuation of Facebook, determine the appropriate tax lots that needed to be sold for this, and create a schedule for diversification. And after we were able to solve for that immediate need, which was the income stream, we had to build things out in bite-sized chunks, take care of everything else in bite-sized chunks due to his busy schedule. So we created a weekly schedule of things to tackle in just short bursts. So meetings with the estate planning attorney, an estate planning attorney that specializes in working with executives at publicly traded companies. He had been using TurboTax for his taxes, so we introduced him to a CPA that specializes in executive comp. And then we created an action plan around the remaining assets, some of which that we're going to talk about when we talk strategies here shortly, but carving off $5 million for assets that he didn't foresee ever needing to touch, and earmarking that more of as an estate planning solution for his kids. And for this client specifically, that was $5 million into an exchange fund over a number of years. And then what we're working on with him now, one of the things is just figuring out the rest of the diversification scenario, given the Biden tax proposal, creating a bull case and a bear case, depending on what direction that goes in the coming year. So fast forward to today, with the bulk of that planning, the tax planning, the estate planning, in the first part of the diversification done and out of the way, this client was actually able to go to his employer early last year and tell them of his intentions of leaving by the end of the year. And the latest planning we've done for him has all been really interesting stuff. So the family had been vacationing to Tahoe twice a year, and they knew that that was a destination they wanted to be at retirement. And they didn't know, is it best to be on the California side, or do I want to be on the Nevada side? California's cheaper. Nevada's side cheaper in terms of taxes. And what we were able to find out was for him, the amount of the differential, the delta there, was so small that it was really a wash. So we implored him to go after his dream home. And he always wanted to live on the Nevada side. Home's more expensive, but ultimately was able to, what they were working on now, which is to get into their dream home over there. So that's the story, just to give an idea of how we would start with someone with a concentrated positions and incorporate some of the planning and some of the long-term goals. And now I want to transition to more of the educational component of today's discussion, and we'll start to talk about the 7 diversification tools in our tool belt. So, Ann, next slide, please. So the first that we're going to discuss today is tax-sensitive strategic selling. It was a big part of the story that I just mentioned, but for many places you would go to access financial planning, this is generally the plain vanilla, the one solution that a firm may have that's kind of non-specialist in nature. You have tax-sensitive strategic selling as an option. But it is a solution for, in most cases, is incorporated with a number of the different strategies that we are going to talk about today. So some of the pros and cons. The pros are that it allows for capital gains budgeting and customizing a budgeting approach tailor fit to a client, and diversifying into additional asset classes. When the client situation before, he had a concentration of Facebook, and just diversifying that over a number of different asset classes, a number of different positions, smoothing the ride a little bit. The cons for a tax sensitive strategic selling strategy is you paying the capital gains sooner rather than later. So there is an element of, there's the potential for, if you hadn't have sold, there's a tax deferred growth function there that you're missing out on. So the opportunity costs of diversifying out of a growth oriented position like Facebook. So next slide, Ann. So the next I wanted to discuss is exchange funds. So this is starting to get into some of the more interesting solutions. But an exchange fund essentially turns a concentration into a basket of stocks, an exchange fund. Your basis stays the same. You're really kicking the tax can down the road. You're not getting any sort of tax benefit as far as you're still going to have to pay that tax burden at some point. But there's a couple of reasons why we would use an exchange fund. One solution would be for, let's say, a client that has a few years leading up to retirement. They may want to diversify off at least enough so they understand what their net worth is going to look like, say when they retire. There's not a lot of a guessing game, and then they can get out of the exchange fund. The exchange fund, you hold the assets. They're held in the exchange fund for 7 years. So it's a 7-year lockup period. But if you were to use that, let's say 7 years, 5 years prior to retirement, and then you can sell these assets once you're retired and you're at a lower tax bracket at that point. The other way, and the way that we used in the case study that I mentioned earlier, is more of kind of an estate planning tool. So a portion of the assets that don't plan to ever be touched, and again, smoothing out the ride, not just having one concentrated position that you're leaving to your heirs, but you have a better idea of what that position is going to look like and how it's going to grow into the future. So as an estate planning tool, giving through an exchange fund and being able to get that step up in basis at your passing to the heirs. So the pros for a strategy like for an exchange fund, it reduces the exposure to risk associated with owning one company. You're diversifying into what's essentially either a proxy for the S&P 500 or a proxy for something like the Russell 1000, for instance. It's not reducing taxes, but it does have an element of tax deferred growth as opposed to the tax sensitive strategic selling strategy. You don't sell the assets, more pool of assets to grow over time. And then compared to the sale of a stock, it may have a substantial return advantage over investing after tax proceeds. And then some of the cons for an exchange fund: not all equities are accepted. A lot of times when we find an opportunity for an exchange fund that makes sense for a client, we often have them fill the paperwork out for the exchange fund and basically sit on a waiting list, because we'll get an email from an Eaton Vance or Goldman Sachs, both of the institutions that we use, and it'll say, we have $20 million in availability for Facebook, first come, first serve. So it can be difficult to get in, and they're not always accepting the equities that you would like to put in an exchange fund. Also, when you think it's a bright idea to be in an exchange fund, all of your colleagues also think of that idea at the same time. So it's very competitive to get in. Another thing, redemptions are limited in the first 7 years. You're technically locking it up for 7 years to be able to get that diversified basket at the end of the 7 years. But if you were to, for whatever reason, need that money in the first 3 years, you still have access to it. You're just going to pay a 1% penalty. If you wanted the assets before the 7 years, but it's in between 3 and 7 years, you can get that money back, but you're going to be getting your position back and not a diversified basket. But from 3 to 7 years, there's no penalty on that. And then the basis stays the same. So again, just kicking the tax can down the road. Other than the tax deferred growth that we mentioned, there's really not an advantage from a tax standpoint. And it's a premium offer. There's only 2 main players in the exchange fund industry, Eaton Vance and Goldman Sachs. We work with both of them. It's a premium offering, and because of that, it's a little more expensive than your typical diversification into securities. Next slide, Ann. So the last one that I'm going to discuss with us today is qualified opportunity zones. In some ways, works very similar to an exchange fund. In some ways, it's very different. So qualified opportunity zone is an investment in an economically distressed community. And again, you're just kicking the tax can down the road, and there's a lockup period of 10 years, but at the end of those 10 years, you can get a 10% step up in basis. So you're kicking the tax can down the road, but there is some tax benefit above and beyond just the tax deferred growth. So who we would use this strategy for? Typically, someone who has a large gain and is looking to diversify not only just into different asset classes, but into real estate specifically. One example recently, we had a client that, to not go into it completely, accidentally sold a $2 million position of Google. And in that situation, they had a $900,000 gain, and they thought you put the whole $2 million in the opportunity zone and you're done. But realistically, you just have to put the portion of the gain. So we did some due diligence on qualified opportunity zone, define one that made sense for that $900,000 gain and help them get into it. So that would be an example of who would use a qualified opportunity zone. Pros and cons for qualified opportunity zone. The pros are you get the step up in basis after 10 years. It also, like the exchange fund, operates somewhat like a tax deferred vehicle, more pool of assets growing over a longer period of time rather than selling up front. And you're diversifying into another asset class, as I mentioned. And then some of the cons, the investments are locked up for 10 years. Usually when you're making the commitment to be in an opportunity zone, you're in it for the long haul, because the carrot at the end of the road is that 10% step up in basis. Also, it's another one of these premium offers. Just generically speaking, the real estate alternatives by their nature are generally a premium offer, more expensive than your typical management fees. And then you also run the risk the overall returns after getting that step up in basis may not result in a better overall outcome or more money at the end of the day. And that's where financial planning really helps us define whether it is a good tool to use for a specific client. So that's all for my story time and my portion of the 7 diversification tools. I'll turn it over to my colleague, Alex Leitzis, to discuss the 4 remaining tools in the tool belt.
Thank you, Braren. Next, we're going to discuss 2 option-specific strategies. We'll start with options overlay and then move on to a collar strategy. But I do want to preface by saying there's a lot of complexities to these option strategies. So I'm going to keep it very high level and use a very broad brushstroke as I introduce these strategies and who they might be appropriate for. With that being said, we're happy to answer any specific questions in Q&A or directly after the webinar. Again, feel free to submit a question at the bottom with the Q&A option below. An options overlay strategy is designed to enhance total return and generate incremental income. This is a strategy that would be appropriate for someone looking to generate income off of their concentrated position. This type of strategy can be attractive to a holder of a concentrated position for 2 reasons. Number 1, our current interest rate environment doesn't provide much in the way of income generation. And number 2, generally the types of stocks our clients hold concentrated positions in aren't focused on paying a dividend. As my colleague Brian mentioned, Facebook, but the NVIDIAs, Teslas, Apples of the world. So what is an option? It's a derivative security. And what does that mean? It means the option's price is derived from something else. In this instance, that something else is the underlying stock price. It can be a useful strategy for someone who owns a concentrated position, but is concerned with downward market movement. This strategy can help hedge or mitigate to a certain degree. And again, it can help to generate more income. I think a good way to look at this is we're looking to turn volatility into cash and income. There are some things you'll need to be aware of about an option strategy. Like some of the other strategies we introduced, this does not provide any sort of diversification. And while it's unlikely, shares can be called away. So in order to keep them, you would need access to additional capital. And lastly, while performance isn't capped, but with this strategy, if the stock were to sharply appreciate, you could see some underperformance. The next of the option strategies we're going to discuss is called a collar. This is a strategy we might use in conjunction with the tax-sensitive strategic selling strategy that Braren mentioned earlier. A collar might be appropriate for someone who's concerned with short-term stock price movement for their specific concentrated position. It offers a cost-effective way to protect against losses, but because of that, it does limit some of the upside potential of your underlying stock security if it does go up. So really what you're doing is, in order to get some downside protection of your concentrated position, you have to be willing to give up some of that upside potential. There are three parts of the collar strategy, and again, I'm going to keep this very high level. You own the stock, you buy a put, and you sell a call. Just like with the options overlay strategy, this strategy does not offer anything in the way of diversification, and it's intended to protect on the downside. So if the stock does increase, you're likely to see some underperformance. And again, I'm going to preface, both of my colleagues had mentioned this, but as is the case with many of our clients and their complex balance sheets, taxes are always going to play a role in any strategy that we may implement. So the length of the option and the impact or tax consequences that can have is, of course, something we're going to want to understand very intimately before we implement or bring to bear any strategy. In summary, the biggest differentiator between these two option strategies is whether you're looking for short-term income or whether you're looking for some short-term principal protection. Next, we're going to move on to some charitably inclined options. First and foremost, being charitably inclined is absolutely a personal decision. Some folks want to do it throughout their lifetime. Some folks want to do it with their estate when they pass. Some want to leave that decision to their heirs. And quite frankly, some are more interested in the tax benefits of these solutions. Again, that's something we'll learn about you as we work through your financial plan. There's two strategies I'm going to introduce today. Number one is called a Charitable Remainder Unit Trust, or a CRUT, and the second is a Donor Advised Fund, or a DAF. Let's start with the CRUT. A CRUT is a trust that is intended to provide income to a named beneficiary during the grantor's lifetime, and then the remainder of the trust goes to a charitable cause. A CRUT may be suitable for someone who wants to diversify out of their concentrated position, but is concerned with a substantial one-time tax bill. To expand on this a little bit, what happens is you're able to place your concentrated asset into a trust, sell the position, and diversify accordingly, and then not pay any capital gains taxes right away. You only pay taxes as the trust provides distributions to you, which is set up to do so on an annual basis. Without going too much into the nitty-gritty, something that we're going to work with some of our partners on is your life expectancy, your income needs, and the tax implications or tax break that will be afforded to you to help determining the specific stipulations of the trust. So in summary, it's intended to allow you to diversify a highly appreciated asset and spread the tax bill out over the life of the trust or your annual lifetime, provide an annual lifetime income, and afford you that immediate tax break. And again, the proceeds do go to a trust of your choice upon passing of you or the other trustee. Some of the things you'll want to be aware of with the CRUT, though, are the assets are leaving your estate. And again, while this is a tax altering strategy, you're still going to be paying taxes on the distributions of the CRUT. Lastly, we're going to discuss a donor advised fund, or a DAF. A DAF is a charitable investment account. So what does that mean? It means you're going to put assets into a trust specified for one particular or a set of charities. This might be appropriate for someone who's looking for itemized tax deduction, or for someone who wants to have assets earmarked for a for but wants them to continue to grow tax-free into the future. As I mentioned, you're afforded an immediate tax break for both state and federal taxes when you make that contribution to the DAF right away. And so some of the things you'll want to take into consideration are the contribution has to be made to a public charity or a 501c3. And again, the funds can be invested for tax-free growth. So you can contribute to the DAF, receive the tax break, and allow the funds to grow tax-free and make the charitable contribution at a later date. Again, some of the things you'll want to be aware of, these assets are also leaving your estate in this instance, and this might not be an appropriate strategy for someone who isn't otherwise charitably inclined. Now that we've covered the 7 diversification strategies, I'm going to pass it back to Alex Katz, who's going to share with you an example of how we brought a handful of these strategies to bear with a client of ours.
Perfect. Thank you so much, Alex and Braren. Appreciate it. Okay, hopefully that last section was educational, good overview for everyone, and yet hopefully we didn't lose people and you're not asleep. But with that, let's move on to story number 2. And this example is actually a relatively simple case that showcases two of the concentrated position solutions we recently brought to bear for a client, two of the ones that we just discussed. One being the DAF that Alex was just talking about, and the other being the tax-sensitive diversification that Baron started the conversation with. So as we go into the next slide, I'll just acknowledge up front that the analysis on the screen is absolutely an eye chart. It's going to be very difficult for you to see. Don't squint your eyes. I will zoom in and we'll take you through the details. Before we get to that, let me set the stage here. So this is a client who had worked for NVIDIA for about a decade when she came to us with her concentrated wealth. And she had more than 80% of her wealth in NVIDIA stock due to RSU grants that she had received over the years and never sold a single one. And she'd been a long-time participant in the employee stock purchase program. So lots of concentration risk on her balance sheet. Now, it came out in the financial planning conversation that she was also quite charitably inclined, gifting roughly $30,000 a year to 3 or 4 causes that were very important to her. However, she was gifting to these strategies in a very tax inefficient manner by simply gifting after tax dollars. So our primary goal with her was to create tax sensitive diversification, so she both didn't have all of her proverbial eggs in one basket and also didn't end up giving lots of those eggs to Uncle Sam. The fact that we could also handle her charitable gifting in a much more efficient manner was just a big bonus here. So now let's zoom in and I'll walk you through this analysis a little bit. So what you see here is just a zoom in of the top row of the spreadsheet, and you can see these are each of her each of her RSU grants. We did a different analysis on her ESPPs, but this shows the date of the grant, the quantity, the price, cost per share, market value, cost basis, gain loss within each lot, and then the really important column, the one with the formatting, the shading that starts at the top and in green and goes down to red at the bottom, is that gain loss percentage column. So that's the one that we were really focused in on. Then of course we need to look at the holding period, meaning is this a short-term gain or a long-term gain? And then of course the next question is, okay, great. Now tactically, what are we going to do with that? So if we zoom back out here, what you can probably see is for some of those green and into yellow shares at the top of the list, the ones that are long-term, not the ones with the blue shading that are short-term, those were the lots that we identified as the ones to sell. And when we look to the bottom, you can see the most highly appreciated lots, the ones with the orange and red coloring. Those were the lots that we identified as the ones to donate to a donor advised fund in order to create that taxable offset. So now let's see how the results panned out. And we're just zooming in on that box on the upper right. So what you can see here is for this client, she's starting with just under $4 million in NVIDIA RSUs. The short-term value is about $1 million, meaning the long-term gains equate to about $3 million worth of value. So our recommended sellable value in order to create some meaningful diversification for this client was 1.3 million. We then recommended gifting 450,000 into her donor advised fund. And some of you may be saying to yourself, wait a minute, you said a second ago that she gifts $30,000 a year. So where does this $450,000 number come from? And the idea is that you are gifting into this donor advised fund many years worth of charitable gifting. So you're going to get the tax benefit of making the gift into the donor advised fund in the year that you make that gift to the DAF. You can then spread out those donations to the actual end charities over many, many years. So in this case, you can think of it as, $30,000 a year. $450,000 is essentially 15 years worth of charitable gifting that she was donating up front so that she was getting the most tax benefit that she could possibly get. So in this case, after the gift and to the donor advised fund and the sellable value, there was about 2.2 million left in RSUs still invested in NVIDIA stock. So certainly she still has quite a bit of exposure to her employer's stock, but we were able to reduce the risk exposure by 45%. The gains in the taxable sale were about $740,000. Excuse me, the gains were $740,000, which at 37% tax rate equates to about $275,000 in taxes, which no one wants to pay. The donor advised fund contribution of $450,000 leads to, with a 50% taxable offset, allowed us to offset $227,000 worth of those gains. So the bottom line in this situation was that we were able to meaningfully reduce the exposure of very highly appreciated NVIDIA shares, and yet at the end of the day, we only had a $47,000 tax bill. No one wants to spend $47,000 in taxes. I acknowledge that, but it's certainly a heck of a lot better than $275,000 in taxes. So quick example, simple case using two of the tools that we discussed earlier, but we thought this would be a helpful way just to kind of put a bow on the conversation today. A couple more quick slides before we get into Q&A. So one more time, I said it at the beginning, I said it throughout, I'm going to say it one more time here. Financial planning is absolutely the starting point. We have to contextualize the purpose of your assets before we get to the point of tactics and say, what is the right strategy to work towards diversification? So again, worth repeating one more time. Moving on to the next slide. What we would like to offer to you, and before we move into Q&A, our thank you for attending today's webinar is an offer to help you understand both your portfolio's risk profile and your personal tolerance to risk, as I shared earlier with that those pretty charts, the green bands. So we'll send out a follow-up email to all of the attendees today with more details, but in brief, it's a two-step process. Step one, you'll complete a 5 to 10 minute survey in order to understand your personal relationship with risk. Again, this would be a score of 1 to 99. And I like to think of this as your ability to sleep at night score. So 99 meaning you can sleep through just about anything, and 1 meaning the faintest noise is going to wake you up. So first and foremost, understanding your personal relationship with risk. And then step 2 is for us to run an analysis on your existing portfolio to see how your portfolio risk lines up with your personal risk score. I will say in almost every case we've seen, there's a pretty significant gap between how a concentrated positions portfolio is positioned and the individual owner of that portfolio's risk score. So we would be delighted to help provide this clarity for you. And of course, discuss diversification strategies that might make sense, one more time, within the context of your financial plan. So with that, I'm sure we've got quite a few questions that have lined up. I've already mentioned at the top, but we have Aaron Zager, who is certified financial planner and one of our senior financial advisors who runs our advisory team. He's going to be handling the Q&A, and Braren is going to moderate and fire those questions at Aaron. So with that, I will turn it over to Braren and Aaron.
Thank you, Alex.
All right, thank you. Here's the first one. In the presentation, you mentioned tax-sensitive strategic selling. What exactly are you diversifying into? ETFs, stocks, bonds?
So tax-sensitive selling is when exactly we're selling appreciated securities. And we do a lot of work reviewing the different tranches, the different cost basis of ISOs, non-qualifieds, RSUs, ESPP, whatever they vest. And there's different tax implications for each type of equity. For tax-sensitive selling, and this is what most firms offer, it's either hold or sell. We're a little bit more sophisticated than that, where we actually have tax planning software where we can upload a tax return and run multi-year selling strategies to find out how to minimize taxes as much as we can. Of course, if you have appreciated securities and you're going to sell, you will pay taxes at some point. That's the downfall of making a good investment. But if your income varies between year and year, if you're in a high income earning year today or have a liquidity event and it's going to be lower next year or the year after, we can develop strategies, multi-year strategies, to not only sell and diversify according to your financial plan, but also do so in the most tax efficient way possible.
And then the second part of the question, what exactly are you diversifying into once you diversify?
This might be a common trend here, but it kind of depends. As Alex Katz pointed to, we are very much a financial planning firm where we're going to go through your financial plan. We're going to look through the concentrated position, the amount of volatility, the percentage that concentrated position has, in accordance with your overall financial balance sheet. And in some cases, and especially here in the Bay Area, we talked about opportunity zones. This is something that is relatively new post 2018, after the Tax Cuts and Jobs Act. So opportunity zones are relatively new, and many of our clients in the Bay Area own a substantial percentage of their net worth into real estate. So we'll look to see what makes sense for you. What's your risk appetite? What's your risk tolerance? And it might be stocks, bonds, it might be a combination of real estate. Or exchange funds and options overlay, as we mentioned prior. But it really depends on that person's specific situation.
Yeah, Aaron, I would just add to that. If you go back to the slide that I showed when I was showing those the green circles, the second one that I showed was a Summitry managed portfolio, diversified 25 to 35 individual securities that may be held on the stock side, individual bonds, whether corporates or munis on the fixed income side. But the key is building a portfolio. When we have a client who has a highly concentrated position, let's say it's the NVIDIA example I used at the end, the portfolio that we're going to build for that client, very much by design, is going to be complementary to what that client has outside of our management, because they still are going to maintain some exposure to NVIDIA. So just to be blunt, to make the point, the last thing an NVIDIA client wants from us is for us to buy more NVIDIA for them, or to buy some really highly correlated stocks. So the idea is to build a diversified portfolio that's complementary to your overall balance sheet.
Thank you. And then staying on the same with tax sensitive strategic selling in mind. Another question here: what makes a stock sale categorized as long-term versus short-term capital gains, and does it matter what type of stock is sold?
It does. So typically, if you were to go out into a brokerage account and buy a stock today, as long as you did not sell it within a year, then it would be considered a long-term capital gain. So with the tax code, long-term capital gains receive preferential tax treatment. On the federal side, the highest it could be taxed is 23.8%. If it's short-term and you buy and sell something at a gain within the year, then it does not receive preferential tax treatment. So it's taxed as ordinary gains, which the highest is 37%. So there's a big delta between long-term and short-term capital gains if you were to go out on your own and buy a stock in a brokerage account. It does differ with equity compensation, which I think is very much related to the conversation today. For equity compensation, there are grant dates, and there are things called disqualifying dispositions. So for ESPP or options, it's considered long-term if it's either 2 years from the grant date or 1 year from the purchase date. So you have to be really cognizant of when the grant date is when you're dealing with ISOs or non-qualified options or ESPP. Everything else, including restricted stock units vesting, it's 1 year from the vest date, and as long as that happens, then it's considered long-term. So there are nuances here as far as equity compensation, but just going and buying a stock in a brokerage account, it's pretty straightforward. It's wait for a year, and then you sell it at a gain, and it receives preferential tax treatment.
Great, thank you. And then the next question we have a couple questions in regards to one of the things we mentioned earlier, the Charitable Remainder Unit Trust, or a CRUT. And the questions all revolve around kind of the same: how long the CRUT lasts for, and how long can they take advantage of the income stream? Maybe just a little more on the CRUT and going into more info, but specific on the income stream portion.
Yeah, first of all, just to go back to your point earlier, you need to be charitably inclined to create a CRUT or a donor advised fund to begin with. There are significant tax savings. Appreciated stock, you don't pay capital gains tax, and the value of that stock at the time of transfer, that's all considered, you receive an itemized deduction for the value of stock. So again, not only do you not receive capital gains tax, but you also receive a pretty large deduction. But you need to be charitably inclined. Again, for the Charitable Remainder Unit Trust, typically it makes sense if you're looking to contribute at least $1 million to the trust. And keep in mind, this is an irrevocable gift, meaning once you transfer it to the CRUT or to the DAF, that money is no longer yours. The benefit is that it's no longer part of your estate as well. So the growth from when you transfer it to the CRUT or the DAF up until that time comes when you pass away, all of that is excluded from your estate. And the CRUT pays consistent income to your beneficiary, whether that's you or your kids or someone else. And that is considered ordinary income to the person receiving it. As far as timing, this is an irrevocable gift that generally goes to the charity and the causes that you care about that are identified in the CRUT at the time of your passing, or at the second to die. It could be you and your spouse are both listed as grantors on the irrevocable trust. But once you make it, it's an irrevocable gift, and it typically gets passed to the charities of your choice at your passing.
Great, and then let me see here. Yeah, and then Aaron, if you could go into some more detail on just how concentrated positions may impact on the estate planning side, or some things to think about.
Yeah, absolutely. So as the current tax law is now, once you pass away, your assets receive a step up in basis. So if you bought NVIDIA at $5 a share and now it's $300, well, when you pass away, there's a step up in basis. So now the new basis is $300 a share. It does impact the estate choices very much, where currently we have a pretty high federal estate tax exemption, where it's about $23 million for a couple married. That's all set. That's all going to go away, and the sunset provisions will occur in after 2025. So they'll go back to the old 6 and change million adjusted for inflation going forward. So there are things to consider. What we know now is that this very high federal estate exemption will go away. The sunset provisions will kick in post 2025. And creating a CRUT or contributing to a donor advised fund, or there's all of these very complex ways of planning for estate reduction strategies. And we can plan for what we know now. There's a lot going on in the administration. Right now, they're just proposals, and we don't necessarily know what will be the final, the final tax law regarding the estate tax. But moving highly appreciated security into a DAF, into a CRUT, into charitable remainder annuity trusts, there's charitable lead trusts, there's all of these different very sophisticated strategies in order to move appreciated security, not pay tax, and remove that from your estate.
Thank you again. We have a couple more questions. Again, if you want to get questions in here, we have 5 minutes remaining. So again, the Q&A button at the bottom. We have a couple more here though in the queue. Alex, maybe this is a good one for you. The question revolves around fees, minimums, and kind of getting a sense of what they can expect to what exactly what we do before they have to make a commitment. So what does it look like to build out a diversification plan, and like how much work up front and to the point where we bring them on as a client?
Yeah, I was wondering if you were going to ask that one, Brian. I was waiting for that. I think it's a 3-part question. So it was first, how can I engage Summitry in a diversification plan? What are your fees and minimums? And then what are the restrictions specifically around exchange funds? So how to engage Summitry in a diversification plan, that's pretty easy. Feel free to send us an email. You can either send it to any one of us. I'm alex@summitry.com. That's probably the easiest one. And we'll start the conversation, get to know who you are, get to know what you're interested in. We actually engage in the financial planning process with people who are interested in becoming clients of our firm before they commit to being clients, so that they can actually experience what it's like to have that value in their lives. So we're happy to begin that conversation with anyone who's interested in doing so. So pretty straightforward there. In terms of fees and minimums, the couple of things that I would say, certainly they're specific to the individual, but what I would say from a broad brushstroke standpoint are, from a fee standpoint, what is most important for you to know is that we have structured our fees such that there are no conflicts of interest between Summitry and our clients. So we collect fees that are a percentage of the assets that you entrust us to manage. If your assets go up in value, that's good for you and good for us. If your assets go down in value, that's less good for you and less good for us. So there's a perfect alignment of interests there. We don't have any, commissions or anything along those lines that lead to those conflicts of interest in the broader financial services industry. Summitry is also a fiduciary, so by definition, we must put our clients' interests ahead of our own. So broadly on fees, that's how structurally they work. For anyone who wants to speak more specifically, I'm happy to have that conversation with you. For minimums, we do have a stated minimum, but really the way we think about our engagement with our clients is we need to have enough of a commitment of assets from our clients where we can have an impact on your financial well-being. And in broad brushstrokes, you can think of that as maybe 60 to 75% of our clients' liquid net worth is a number where we can really start to have an impact. Be extreme to make a case. In Braaron's example, a client with $20 million, if they had said, here's $1 million, Summitry, we're managing 5% of the liquid net worth of that client, and we really would not be able to have much of an impact whatsoever. So our driving motivation is we want to influence and impact your financial well-being into the future, and that's what influences our decision around what a minimum engagement would be. And then restrictions on exchange funds specifically, these are not our restrictions. These are from the 2 providers of exchange funds out there, Goldman Sachs and Eaton Vance. And as Braaron mentioned, we have relationships with both. They have net worth requirements for investors who invest in the exchange fund. So from a net worth standpoint, meaning investable net worth, you need to have at least $5 million, which could be comprised of liquid assets, your brokerage accounts, your IRAs, and the likes. It can also include investment real estate, but it cannot include primary residence real estate. So that's their minimum. And then for the individual commitment to the exchange funds, There are 3 or 4 different funds across those 2 different providers. Generally, they're looking for at least $1 million to come into the fund. And candidly, for most people who are interested in an exchange fund, the wealth needs to be at a certain level where $1 million would start to actually make an impact. So that number generally seems about right in our interactions with the exchange funds. So that was, I think I knocked out all 3 of them.
You did.
And I think we're right at 1 o'clock.
We're right at 1 o'clock. I wanted to thank everyone for attending today. I know it's been about a year and a half of Zoom fatigue, so I appreciate you hanging in there for an hour during lunch with us. And if you have any other questions we didn't get to today, feel free again, alex@summitry.com. Alex would be happy to address any further questions. But with that, we'll let you get back onto the rest of your day.
Thanks, everyone.
Thanks, everyone.
Take care.
Bye.